Intel shares sinking nearly 8% today. That's the market missing the forest for the trees on a 15% revenue jump. This isn't a red flag, it's a re-rating opportunity. You're on InvestIq. While the TSX Composite added 0.5% and our big banks like TD and RBC saw modest gains, the real story for tech investors is Intel, down 7.89%. Everyone's fixated on margin compression, ignoring the underlying demand signal. Apple, surprisingly, had a strong day up 3.53%, while the leveraged semiconductor ETF Soxal got absolutely hammered, down over 13%. Bitcoin even dipped 1.34%. But Intel's dive today, after reporting a 15% revenue increase, is the classic overreaction. Most analysts will tell you that the lower-than-expected gross margins show Intel can't compete effectively in the AI arms race. They'll point to increased capex and lower profitability as proof the foundry business is a money pit. They'll say NBIS, down 15%, is the canary in the coal mine for the whole sector. But that's short-sighted. This 15% revenue growth isn't just organic, it's fueled by unprecedented demand for AI infrastructure, a demand Intel is finally starting to meet. The margin hit is a direct consequence of scaling up new, complex foundry operations. You build the factory, then you get the scale. This isn't a problem, it's the cost of entry to a booming market. The takeaway. This dip isn't about structural weakness, it's about front-loaded investment in a high-growth sector. Intel is doing exactly what it needs to do to become a major AI player. This isn't a sign of unfixable issues, it's the growing pains of a legacy giant finally catching an AI wave. And for the patient investor, that 15% revenue increase is a far more important number than today's stock price drop. I'm InvestIq. That's how I read it today. This is analysis, not advice.